Index funds versus stock picking long-term compounding simulations. Hey everyone, welcome back. If you've been following this series, you now have a strong conceptual foundation. How money works, what central banks do, how inflation affects your wealth, what the different asset classes return over time, and how correlation shapes portfolio risk. Today we get practical. The question I get more than any other. What should I actually buy? The honest answer, grounded in decades of data, is simpler than most people expect. It's also counterintuitive to most people's instincts. We're going to compare index fund investing to individual stock picking with actual performance data, run the compounding simulations that show what consistent investing actually produces over time, and identify the 3 behavioral mistakes that destroy long-term returns for investors who otherwise do everything right. By the end of this video, you should be able to answer "What should I buy?" with a data-backed answer you can explain in your own words. Let's go. Before we talk about what to buy, we need to talk about where to hold it, because the tax treatment of your investment account may be as important as the investment itself. Whether it's Japan's NISA, the UK's ISA, the US's Roth IRA or 401k, Canada's TFSA, or Germany's various tax-advantaged structures, the principle is the same. Investments held in these accounts grow without being subject to capital gains tax and, depending on the account type, without dividend or interest tax as well. Why does this matter so much? Consider a straightforward example. You invest and earn a 7% annual return. In a standard taxable account, in most jurisdictions that return is taxed, typically 20 to 30% of gains, either annually on dividends or at the point of sale. In a tax-advantaged account, those taxes don't apply. The full 7% compounds, year after year, untouched. Over 30 years, the difference is not small. An investor earning 7% in a taxable account effectively earns something closer to 5.5 or 6% after tax in real compounding terms. The tax-advantaged account delivers the full 7%. On a $500 per month contribution over 30 years, this difference compounds to hundreds of thousands of dollars in additional wealth. The first and most important decision in personal investing isn't what to buy, it's to maximize contributions to tax-advantaged accounts before buying anything in a taxable account. The tax benefit is guaranteed. The investment return is not. Take the guarantee first. Let's look at what consistent monthly investing actually produces, using a 7% annual return assumption, close to the long-run real return of global equity index funds based on historical data. Several things stand out from this table. First, the nonlinearity of compounding. At $1,000 per month, you accumulate roughly $172,000 in 10 years. In 20 years, $505,000. In 30 years, $1.1 million. The jump from year 20 to year 30, $595,000 of additional wealth in a single decade, is larger than the entire 20-year accumulation. This is the core mathematical reality of compound growth. It accelerates. The same 10 years of contributions produce dramatically more wealth in years 20 to 30 than in years 1 to 10. The implication is not subtle. Starting earlier is not marginally better, it is transformatively better. An investor who starts at 25 will accumulate substantially more by 65 than one who starts at 35, even if the later starter contributes more per month to compensate. Second, the relationship between principal and gains widens dramatically over time. At $1,000 per month for 30 years, your total principal contributed is $360,000. Your ending wealth at 7% is approximately $1.1 million. The $740,000 difference, more than double the principal, was generated purely by time and compounding. You didn't earn that from working. You earned it from waiting. Third, the simulation assumes continuous contributions regardless of market conditions. The investor in this model does not stop contributing when markets fall, which is precisely the behavior that separates long-term accumulators from everyone else. We'll come back to this. Now to the question that generates the most debate. Index funds or individual stock picking? Before the data. Let's be clear about what each approach involves. The data on this question is remarkably consistent across decades, geographies, and time periods. The S&P Dow Jones Indices publishes the SPIVA report annually, the most comprehensive tracking of active fund manager performance versus passive index benchmarks. The 2023 results. Over a 5-year period, approximately 87% of U.S. large-cap active fund managers underperformed the S&P 500. Over 10 years, approximately 94% underperformed. Over 20 years, approximately 96% underperformed. These are professional investors, people with MBA degrees from elite universities, teams of analysts, Bloomberg terminals, proprietary research, and decades of experience. More than 9 out of 10 of them, over long periods, fail to beat a simple index fund that charges a fraction of a percent and requires no judgment. The reasons this happens are well understood. Markets are information efficient in the aggregate, prices reflect the collective knowledge and analysis of all participants simultaneously. When you try to beat the market, you're competing against that aggregate intelligence. Every stock you buy that's undervalued was sold by someone who believed it was fairly valued or overvalued. One of you is right. Over long periods, there's no reliable way for any individual investor, amateur or professional, to be systematically on the right side of those trades. There's also the cost drag. Active funds charge fees of 0.5 to 1.5% annually. An index fund charges 0.03 to 0.1%. That 1% difference compounds dramatically over 30 years. On a $500,000 portfolio, an additional 1% in annual fees destroys approximately $170,000 of wealth over 30 years. None of this means that individual stock picking is impossible. Some investors do beat the market consistently, Warren Buffett being the most famous example. But Buffett himself has repeatedly said that for most investors, most of the time, a low-cost S&P 500 index fund is the appropriate vehicle. The evidence supports him. Given the evidence, what should a long-term investor actually buy in a tax-advantaged account? The data-backed answer for the majority of investors. A globally diversified equity index fund, ideally one tracking the MSCI World All-Country or a similar global benchmark, with low annual costs. This gives exposure to thousands of companies across dozens of countries, rebalanced automatically according to market capitalizations, at minimal cost. The case for global diversification over US only is worth examining. The US has been the world's best-performing major equity market for the past 15 years. But this has not always been true. In the 1970s and 2000s, international stocks significantly outperformed US stocks. Japan was the world's best-performing major market in the 1980s, and we know what happened next. Diversifying globally ensures you capture whichever market performs best, without having to predict which that will be. The case for US only is also legitimate. The US contains the largest, most innovative, and most globally dominant companies in the world. Many S&P 500 companies, Apple, Microsoft, Amazon, generate the majority of their revenue internationally, providing de facto global exposure. US capital markets are the deepest and most liquid in the world. If you want simplicity and are comfortable with the US concentration trade-off, a low-cost S&P 500 index fund is a well-supported choice. On cost. This is the one variable you can control. 2 index funds tracking the identical benchmark will produce identical gross returns. The only difference is fees. An annual expense ratio of 0.03% versus 0.5% adds up to tens of thousands of dollars in additional wealth over 30 years on meaningful portfolios. Always choose the lowest cost option that tracks your chosen benchmark. On dividend funds and income strategies. For investors who want regular income payments, dividend-focused index funds are a legitimate option. Within a tax-advantaged account, dividends can be received without tax drag. However, for pure wealth accumulation, total return index funds, which reinvest dividends rather than distributing them, typically outperform dividend-focused funds over long time horizons, because the reinvested dividends compound continuously. The evidence strongly favors low-cost index fund investing, held consistently over long periods. But the strategy only works if you actually follow it. And most people don't, not because they make the wrong initial investment decision, but because of behavioral responses to market volatility that override their long-term intentions. Behavioral mistake number 1. Selling during market downturns. In March 2020, global equity markets fell 30 to 40% in a matter of weeks. Many investors sold, locking in those losses as permanent. The markets recovered completely within months and went on to make record highs. Those who sold and locked in the loss did not participate in the recovery. Those who held, or better, who increased contributions during the decline, captured the full recovery and subsequent growth. This pattern repeats across every market downturn in history. The 2008 to 2009 crisis. The 2011 European debt crisis. The 2018 December sell-off. The 2020 COVID crash. In every case, markets recovered. In every case, investors who sold near the bottom significantly underperformed those who stayed. The mathematically optimal response to a market decline, for an investor with long time horizons, is to increase contributions, not reduce them. Lower prices mean more shares per dollar invested. Behavioral mistake number 2. Market timing, trying to buy low and sell high. This sounds obviously correct. The problem is that nobody can reliably do it. The best days in the market are frequently clustered near the worst days. J.P. Morgan's annual market research consistently shows that missing just the 10 best trading days in any given decade reduces returns by approximately half. An investor who was out of the market on those 10 days, perhaps because they had moved to cash anticipating a decline, would have dramatically underperformed someone who simply stayed invested. Behavioral mistake number 3. Delaying the start. I'll invest when I understand it better. I'll wait until the market corrects. I'll start once I pay off my car. Every month of delay costs real money, because every month is a month of compounding foregone. A 35-year-old who starts investing today and a 35-year-old who waits 5 years to start will end up with dramatically different retirement wealth, even if they contribute identical amounts per month for the rest of their working lives. The 5-year delay costs, not months of contributions, but years of compounding on every subsequent dollar contributed. Here's the summary of everything we've covered today. First, maximize contributions to tax-advantaged accounts before investing in taxable accounts. The guaranteed tax benefit is the highest certainty return available to any investor. Second, the data on active versus passive investing is clear and consistent. More than 90% of professional active managers underperform simple index funds over long periods. Individual stock picking requires competing with those professionals, and losing, on average. For most investors at most stages, a globally diversified low-cost index fund is the most defensible choice. Third, the compounding simulations show that consistent monthly investing over decades produces substantial wealth that scales dramatically with time. The wealth generated in years 20 to 30 exceeds the wealth generated in years 1 to 20. Time is the most powerful variable in investing, more powerful than the amount contributed, more powerful than the specific fund chosen. Fourth, the 3 behavioral mistakes, panic selling, market timing, and delaying the start, destroy more long-term wealth than any investment choice. The strategy is simple. Executing it through volatility is hard. Understanding why the strategy works helps you hold through the volatility. The answer to "what should I buy" is simple. A globally diversified, low-cost index fund, in a tax-advantaged account, contributed to regularly, held without selling. That's it. The difficulty isn't the answer, it's having the discipline to follow it for decades. Thanks for watching. A subscribe and like makes a real difference for the channel. See you next time. Note: this video is for educational purposes and does not constitute financial advice. Please make investment decisions based on your own circumstances and consult a qualified advisor if needed. Thank you so much for watching until the end. If you have any questions or comments, feel free to leave them below. We're also looking for topics you'd like us to cover next, so let us know. Don't forget to subscribe and hit the like button if you enjoyed this video. Don't miss the next episode. Subscribe to the channel and hit the bell.